What's up, everyone? Welcome back. Mike the Mortgage Guy here with another video. Drum roll, please. Let's go. Today we're getting back to the basics a little bit, guys. We're gonna go with some FAQs, some frequently asked questions. In a market like it is right now, a volatile market, these are kind of the back to basics questions that we get. And I wanted to go over a list of some questions that my clients have been asking me recently. A lot of repetitive questions that I've been getting to the point where I've been kind of making notes and mentally going in my head of what I want to make a video about because I feel like these are a lot of the questions that a lot of clients ask that are scared to ask, or maybe they think they know the answers, but I just want some clarity on them. Step one is going to be three main things that are going to lower your mortgage interest rate. That seems to be the heavy hitter for most people. They're most concerned with what their interest rate's going to be. So there's a lot of things that go into it, but I'm going to give you the three main things. So to keep it simple, it's going to be your down payment, your credit score, and your loan type. Okay? As we all know, the higher the credit, the better interest rate you're going to be able to get, the better program you're going to be able to get. Now, don't let this scare you away, guys. We work with people that have credit scores in the 500. We even have programs that are no credit score at all required. And again, we can get into what that is. But don't think because I don't have a 750 credit, I can't buy a home. You can. And additionally, we could work with you for long periods of time to boost that credit score up. We have totally free credit repair programs. We're happy to work with clients for a month, 2 months, 6 months, a year, 2 years before we get you ready. Number one, credit score. Number two, down payment amount. So the more money that you come in with for a loan, the less risk involved. So the investor sees that as a better loan. If you come in with only 3% down, that's fine, but you might have a little bit of a higher interest rate. If you come in with 20 or 25% down, that's going to significantly decrease that interest rate. Number three, loan programs. It's not all cut and dry, guys. There isn't one type of loan program that we send out to every person. We listen to our clients, we listen to their situation, and we have tons of programs, and we find that specific box that you fit into, and we make sure that program's right for you, and we make sure that you're getting the best deal you can and the best interest rate possible. So those are the three main things that are going to affect what your mortgage interest rate is. Okay, next thing that I get a lot of questions on are the biggest mortgage myths. This is huge, guys, and I know I've talked about this before if you've seen my other videos, but this is very important. The biggest mortgage myth. What is it? Think about it in your head. You don't need 20% down to buy a home. Guys, you can buy a home with as little as 0% down. There's down payment assistance programs. There's anywhere between 3 and 5% for first-time home buyers, for FHA, for conventional loan programs. There's so many outside the box programs that you could buy. Number one, biggest mortgage myth. Say it with me. You do not need 20% down to buy a home. Next thing, people ask me, this is a very big one too. What happens if I buy a home and mortgage rates drop? A lot of people right now are waiting. Right now, today, it's about mid-August 2025, and the Fed is expected to potentially drop interest rates at their next meeting. Their next meeting is September 17th. That's the next Federal Reserve meeting, and they're expected to drop interest rates by potentially 50 bips, maybe even drop interest rates another 3 to 4 times throughout the year. Well, we want to wait till interest rates drops. Here's a couple things that are going to happen. If you wait for interest rates to drop, one, everyone is waiting for interest rates to drop. When those interest rates do drop, then you have all these new people into this home buying pool. Now, not only are interest rates low, a lot of people might be offering on that home that you love, that you've been keeping an eye on, that's been listed for 6-7 months. Interest rates just drop. Now that home might have 5-6 offers. You might be waiving your contingencies. You might be putting in over asking price. If you get into a home and your interest rate drops, we could always refinance you. Yes, easier said than done. I'm not going to pretend it's free to refinance your loan. It's not. But we have a lot of programs for you guys. If you get into a home and your interest rates drop by a specific amount in that first year, we'll pay those lender fees. We will pay those lender fees to help you refinance. And we'll make sure it makes sense. we're not gonna refinance you from a 7% to a 6.99. I usually like to see interest rates drop by at least 0.5%, but you guys can always refinance at a later date, and those refinance fees actually get financed into the back end of that loan. So you're not coming out with any money out of pocket. Again, I'm not gonna pretend it's free, but you can do this with no money out of pocket. Another thing, number 4, guys, here are some big questions to ask before choosing a lender. Lenders aren't all the same. You might have someone that fits with you based on your personality. You might have someone that fits on you based off what you're expecting to do or what your financial situation is. You might have a bank that you have a relationship with. Number 1, I always advise people to get a couple estimates from people, to get a couple different points of view. This is gonna be one of the biggest financial decisions of your life, guys. It is important to make sure you're working with the right person that has your best interests at heart. But not only the connection you make with someone, you wanna ask them a few things like, what's your average closing time? Some of these banks may be closing loans in 45 to 60 days. You may not have that. Or you may want to make an aggressive offer on a home that does have a few other offers in it, and you wanna close in 14 days. We could do that for you. But you wanna ask that question, is it a possibility? And you wanna set those expectations and make them clear. Another thing you may ask when choosing your lender, do you offer rate locks and what are the terms? When we first pre-approve you, we may give you a specific interest rate on your pre-approval. The market changes every day. You could have a bad day and your next day, your interest rate could be a bit higher. Maybe you get pre-approved and 6 months later, you're going to buy a home and interest rates have changed by 0.5%. You wanna know what terms you're getting into. When are we gonna lock that interest rate? Is it going to be when you get into contract? How long do we lock that interest rate for? And also, what happens if we lock an interest rate while we're in contract and those rates go down? Is there an opportunity to get a better interest rate and change those numbers around a little bit? Those are very important things. So it's not all about your relationship with the lender that you're working with, although that is very important. You wanna make sure that you vibe with that person. You wanna make sure that they have your best interest at heart, but also making sure they have a fiduciary duty towards you as the client. The next important thing, why your pre-approval might fail. Now, when we're getting pre-approved and we send someone a pre-approval, that means they have what we call purchasing power. If we send you a pre-approval for $500,000, we've looked at all your finances, we've looked at where your down payment's coming from, we've looked at your income. At that point in time, with those interest rates that we've quoted you, you're approved for that amount, that $500,000. Here's how that could fail or that pre-approval could no longer be good. 1, and this is very important, guys, what happens a lot of the time, people get a pre-approval and then they go and obtain new debt. If you get a pre-approval and we've looked at your credit, we've looked at your credit score, we've looked at your debts, and then you go buy a new $150,000 truck, motorcycle, boat, you open up a new Best Buy credit card and buy a new surround system, that's gonna affect your debt to income. That could cause your pre-approval to no longer be good. Another thing, like I mentioned before, interest rates do change. They change daily, weekly, monthly. Something could happen with the Fed where we approve you based on that day's interest rates and you're very tight on your ratios. A few weeks, maybe a few months go by and you're finally ready to offer on a home and we run what those interest rates are at that day, they could be a bit higher. If you were very tight on ratios, you could no longer be approved for that full amount. We like to stay very in tune with our clients and keep constant weekly updates with them to avoid these pitfalls. So be sure to contact me and get a hold of me and get in touch with me weekly to ensure that your pre-approval is still good and to make sure you know exactly what's going on in the market. Another question that people ask me, and this is something that they usually don't even have to ask me. I like to go over this in our initial consultation call. Fixed rate versus adjustable rate mortgages. And I'm just gonna give you the quick breakdown. Fixed rate mortgages are your traditional 30-year fixed, 15-year fixed. And when I say fixed, that means your interest rate is unchanging. If we lock you in at a 6.25%, that's what your interest rate's going to be for the term of that loan unless we refinance you. The only reason that your monthly payment may change is because your taxes and insurance change. That principal and interest payment will not change. So that's what breaks down a fixed interest rate loan. An adjustable interest rate loan is a little bit different, and here's how that works. Your introductory rate on a fixed interest rate loan may be a little bit lower. Let's use, for an example, a 7/1 ARM, 7/1 adjustable rate mortgage. And here's what that means. With a 7/1 ARM, your introductory interest rate, say it's 5.99, will be locked for 7 years. That's that first part of that equation, that 7. The second part, now once a year, your interest rate can change. It could go up or down based on what market interest rates are. Now there's also a cap on how much it can move in a specific amount of time, whether it's a 0.5% or a full percent. There's pros and cons to these. If the market does get better, your interest rate could potentially go down, but it could potentially rise significantly as well. So again, this is why us as your loan officers, we stay very in tune with what the market's doing, and we advise you on what's going to be best in that situation. Now, the good thing about these adjustable rate mortgages, if you want to refinance in that first 7-year term before it changes, there's no prepayment penalty, and you could refinance into a fixed 30-year loan at any time you want. One of the last things I'll talk to you guys about today, and this kind of goes back into what we chatted about earlier, the important things that are going to determine what your interest rate is. We talked about credit score. So if we have a lower credit score, what goes into rising a credit score? And here's where we come back into play. We have totally free credit repair systems where we could open up your credit, do a soft pull on your credit, and advise you exactly what you need to do to get that credit score raised. Say you already know that you have a low credit score. You don't want to talk to a loan advisor before you can boost that up a little bit. Here's a few things that you could do to help that credit score. First and most importantly, pay your bills on time. I strongly advise to get auto pay set up on all of your payments, whether it be credit card payments, house payment, a car payment, motorcycle payment. Just set up auto pay, guys. It's going to be a lot easier. If your payment's due on the 5th and you pay on the 6th, you'll be surprised how much of a hit that's going to take on your credit. Secondly, you want to pay those credit cards, those high interest credit cards, off at the end of the month. Not necessarily just paying the minimum payment, but if you have the ability to pay those off each month and utilize them consistently, that's going to show that you have the ability to use your credit wisely, and that's something that's going to give you the ability to rise your credit very quickly. Another thing that I want to talk about that I kind of went into briefly before, but very important when I talk to my clients, and this is why waiting to buy could backfire on you. Waiting to buy could backfire for several reasons. One of my favorite lines that I use is time in the market is always better than timing the market. People always try to time the market and when the best time to buy is. But you got to understand, for the most part, the best time to buy, if you have the financial availability, is now. I can give you 30-year mortgage rate sheets that show the equity gained in homes, and it's always going up. Over time, you're always going to gain equity in that home. It may kind of zigzag a little bit, go down a bit and go back up, but that ladder is always on an upward trend. So remember this, and I know it's one of those cheesy lines, but time in the market is always better than timing the market. What I discussed earlier about waiting for interest rates to potentially fall. Here's why you don't want to do that. Interest rates fall, great, sounds good. Now you have a whole new pool of buyers, like I said earlier, in that market. You potentially are waiving contingencies. You're potentially putting offers in without seeing homes. You have 5 other people that have potentially put offers in, and now you have to come in $5,000, $10,000, $15,000 over asking price. Here in Scottsdale, Arizona, we saw a boom in 2020 and 2021. There were homes up for $750,000. People, without even seeing these properties, investors were coming in and offering $800,000, waiving appraisals, waiving inspection contingencies. This is why it is good to buy in more of these volatile times when interest rates may be a little bit higher. Again, I'm not saying it's always a good time to buy. This is why we'll have a conversation and we'll discuss with you. We'll look at your financials and we'll determine if it is. Waiting to buy could backfire. Another thing I want to discuss with you guys is the potential of interest rate buy downs. There's a couple different ways that you could do this. We have a couple different programs. One's called a 3-2-1 buy down, one's called a 2-1 buy down, or you could just do a cash buy down to buy your interest rate down. Here's how that works. So us mortgage lenders have what we call a rate sheet. When you're ready to buy and we're getting you pre-approved, we go through all of your financials and your credit, and then we pull up that rate sheet for you. We have what's called a par rate for that day. What that means is that rate for that day that's not costing you anything. That's based on your income, that's based on your debt to income and your credit score. Say on that rate sheet that your par rate is 6.5%. Well, you could actually pay money, we call them points, to buy that rate down. The same also applies. Say you're a little low on your down payment funds. You could actually take a credit to get a higher interest rate. It's not a one size fits all that, hey, this is what your interest rate is. You have the opportunity to potentially buy that down or take a credit and buy that up. We usually don't advise that, but there are some situations where that does make sense. Now, in some markets, like it is right now, a buyer's market, you could have a potential. Talk to your realtor. See if you can get a credit or a concession from that seller and actually use that for either your closing costs or to buy the rate down. We've covered a lot of different subjects today, guys. I have a million more I can go over, but we're gonna save that for another video. As always, if you have any questions, reach out to me. matwell@eurekamortgage.net. Mike the Mortgage Guy out.